started. So, first topic, income. Okay, residential mortgage is a property you want to live in. I'm just going to put this down. If you want to live in it, it's regulated, it's residential, and you need income. And the income will dictate the loan size. So I just want to go through every form of income that you might have so that you get a good idea of what the lender's going to want to see, how you need to present it, and the sort of lending levels you can get based on that income. Employment. Okay, if you're employed, you work for a company, ideally you've been past your probation. If you are in probation, there's still a lender that will look at that. Most of the time you wouldn't be in probation, you would have been there more than 6 months, and your basic pre-tax salary, so gross salary, is the figure the lender's going to use to determine what loan size you can get. If you've been there for more than a year or 2 and you get some sort of bonus, annual bonus, 6 monthly bonus, quarterly bonus, the lender will take that most of the time, but how they prove that bonus is they would more than likely want to see a P60. That's what you get at the end of the first year of working for that company. It shows the basic salary and the bonus as 2 separate amounts. What they would normally do in an ideal world, if you've worked at that company for more than 2 years, they would ask for the last 2 P60s, and they would then average that bonus that they see. So they would take this year's with the year before, add it together, divide it by 2, and that would be the average bonus that they will add to your gross basic salary, pre-tax salary. That would be the figure that they would base their lending on. If you haven't been there for a year, then you won't be able to use the bonus most of the time, because there's no way that they can really see that bonus. They would just be trusting you. So most of the time they wouldn't take that. If you've been there for a year, they might take it. So it's a conversation that I'd have to have with a lender, and each lender's different. So worst case scenario, when you're looking at lending levels, always work worst case scenario, because then it can only get better, but then we wouldn't be taking the bonus in those situations. Overtime and commission works very similar. So commission and overtime would normally show on every month's payslip. So again, what they would normally do is take the last 3 months and average those 3 to take that average figure of commission or overtime, and that they would add to the gross basic income, and that would therefore make the amount that they would base their lending on. So yeah, overtime, commission, bonus can get a little more confusing depending on which lender you use, but that is a very broad view. So if you bear that in mind, and as I said, very easily to prove if you've been there more than 1 or 2 years by way of a P60, which the lender would take great comfort from. They would probably average that last 2 years bonus, overtime or commission, depending on the lender. So that gives you an idea on employed. And the other thing is, if you're about to get a pay rise, don't wait till you get the pay rise. Pick up the phone, talk to your broker, because exactly the same thing. There's quite a few lenders that will take that pay rise money now. And as long as that starts normally within 3 months of the application, some lenders are more than happy to take that income. So yeah, don't fall into the first trap and think, I haven't been with my employment for 6 months, or I can't get the property I want because I haven't yet got to that pay rise, but it is coming and I've got another 3 months to wait. You don't, you can actually do it now. So that's tip 1. The next type of employment is self-employed. And within self-employed, there's a couple of categories. First, we're going to look at sole trader, straight partnership. So if you just started in business, or you've got sort of a medium-sized business and you are a sole trader, then you will have a net profit, which means everything you earn, your turnover, less all the expenses that your accountant will take out, that results in a net profit, and that's the amount you're going to be taxed on. That net profit is the income the lender will use. However, if you've been a sole trader for more than 2 years, they will average that income. So that's one thing to bear in mind, and really key to know what your lending levels are going to be. Just going back to sole trader. So if you're a sole trader and you have 1 year's net profit, so 1 year's full accounts, that's fine. There's plenty of lenders that will just take that 1 year's net profit from you, and that's what they would use alone to work out the lending that they will offer you. If you've got 2 years or more of self-employed accounts, net profit, they will average the last 2 years net profit. That average figure is what they would use towards your lending amount. If your latest year is less than the year before, they won't average, they will just take the latest year. So that's a tip there. So you can work out what sort of income your last 2 years accounts work out for you. If it went up year on year, then take an average of the last 2, and that's the figure they're going to be using. If your latest year is lower, which from COVID it may well be that you didn't earn as much this year as you did last year, that's fine too, but they won't average, they will just take that latest year. So sometimes if there is a little drop, then actually that figure is actually more than your average figure. So don't think that just because your business suffered with COVID or that your income's dropped that now you can't get a mortgage. You absolutely can, and sometimes you can get more than if you'd had another good year because you won't get the average. So again, you always think the worst, that you can't get things or the lender won't like seeing your profits dropping, or no, isn't the case at all. So don't worry about that. So if your profits have dropped, you can still get a mortgage. Okay, the other side of sole trader, and just incidentally, partnership is deemed the same as sole trader. It's assessed in exactly the same way. It would just be your share of net profits that they're going to be looking at, and the same would apply. So the other type of self-employed is limited. So if you've, it can be a new limited company. Maybe you've had a sole trader business for a couple of years, which has started to do well. You've earned sort of, you're getting into that bracket where a limited company would be better for you tax-wise. I am not a tax advisor, by the way. That's definitely something your accountant will be talking to you about. But as soon as you get into limited company, you might just have 1 year's limited company accounts. Some lenders will be happy to look at that previous year's sole trader plus your new limited accounts, and they will assess it in the same way. There is a caveat to that, which I'm going to go into in a minute. And if you've got more than 1 year's limited company's accounts, then they will assess it the same way. They will average the last 2 years, unless the latest is less, in which case they won't average, and they will just take your latest year. However, if you're a sole trader or a partnership, they're going to look at net profits. If you're a limited company, you would usually be drawing a salary and a dividend, because that's the most tax efficient way to draw your income when you get a limited company. So most lenders will look at salary and dividend that you've drawn, add these together, average it with the salary and dividend from the year before, unless it's less this year, and average that figure. And that will be the figure they'll use for your lending calculation. If you haven't drawn a dividend, maybe your partner earns well, you prefer to put all the money back in the company, maybe you're a growing company and you haven't taken, maybe you've just taken a salary and not a dividend because you haven't needed to draw that money. There are some lenders that will look at salary and net profits, stroke retained profits, it can be called both, in the business instead of dividend. Now, when you draw a dividend, sometimes you might only draw maybe 30,000 dividend because there's still a tax bracket. If you draw more dividend out, you're going to go over that tax bracket and pay more tax again. So you might not want to do that. So you might have drawn a dividend, but you've left money in the company. So, and now you want to buy this big house, but your dividend and your salary isn't enough to get you there. That's fine. There are lenders that will ignore the dividend and purely look at your retained or net profit in the business. So they'll look at the salary and all the net profit in the business, and that's what they'll use to give you to work out the figure they're going to use for your loan. So again, please don't worry if you haven't taken a dividend. There are lenders with just as good a product as a lender that does take a salary and dividend. So please don't let that put you off. There is an answer for you, sometimes a better answer. So I often find that all these niches where people think they can't borrow, you can actually borrow more than people that sort of fit into the mould. So please don't let these things put you off. Contract workers. These are a bit more difficult. Okay, so contract workers earn well. The majority of the time they're on a daily rate and they really earn well. Some lenders will look at that contract and they will work out their daily rate based on a certain amount of weeks over the year. They have a calculation that they do, which I'm not going to bore you with. If you're a contractor, sometimes you've got a limited company, in which case revert back to what I've just said about limited companies. If you've got a new limited company, or you haven't yet got 1 year's accounts but you have got this contract, or you are purely just a contractor and you get your money from your contract and that's it, there's lenders that will look at the contract as well. So it really doesn't matter if you are just contract or if you've got a limited company which that contract income goes through. Either which way, there is a lender. However, contractors can be a little bit more difficult. There's very few lenders, although there's probably one, that will take a brand new contract without any history of any other contract, or most lenders will like at least 12 months or at least 6 months remaining on the contract, or 2 years of continuous work in the same line of work, or a contract to have been renewed once. So this is a little bit harder to find a lender for, but there are lenders, so don't let it put you off. That's the time when you need a broker, because the brokers will know what lender does what. Don't spend time traipsing the high street, going in, taking 2 weeks to get your appointment, 3 hours watching a video that the branch has to give you because their compliance is even higher than ours. Don't waste your time with credit checks only to be told, no, we can't do that. Don't waste your time. Come to a broker who knows what every single lender in the high street that you're about to spend 2 weeks going through. They'll go straight to the right one. Save you credit checks, which will affect your credit score if you get too many that don't go well. You know, yes, you will probably pay your broker a broker fee. Possibly at the end, we charge ours at the end if it's residential, and it's well worth the money. It is well worth the pain, the time and the money to ask a broker to go straight to the right lender. And I'm not saying a broker gets it right all the time. You know, we can only go with the information that we're given at the time. So of course we will always find the best lender for the client's circumstances. Sometimes underwriters don't like something and it gets pushed back to us, in which case we will just go back to the drawing board and we will go to the next best lender. But overall it still saves you your precious time and credit checks. So yeah, use a broker. Hopefully, you know, they can navigate to the lender for you in a much quicker, less painful time than if you tried to do it yourself. So what have we done? We've done employed, we've done overtime, bonus, commission, we have done self-employed, sole trader and partnership, we have done self-employed limited company, we've done contractor, bank staff, nursing staff. All of that extra income can be included, that's fine. Anybody that has any allowances in their pay, like for example a car allowance, they might not have taken the car, so you get that extra on your pay, that will be acceptable. Any other incomes that you might get. Okay, so apart from your main income, you might have a second job. Okay, how the lender will look at this is a plausible explanation for the hours that you spend doing each job. If it's something that they think is plausible and that you can do both, then they'll take 100% of that income most of the time. So that's fine. Or some lenders might take 50% of the income of a second job rather than 100%. So bear that in mind. Again, worst case scenario, work on 50% of that income. And then you might have rental income. If you've got rental income, that is fine as long as you keep accounts for it. You probably put it through as little sole trader rental accounts, in which case they will ask for the net profit, and it's that figure they'll be using towards your income. And you might have benefits. Some benefits are 100% acceptable. Child benefit often is. So all these little things help to add up to this figure that the lenders are going to use towards your lending multiple. So once we've got that figure, whether it's the average figure or the latest figure if it's dropped, or plus the other income you've got, plus the benefits, plus the rental, maintenance, you might have maintenance payments from an ex-partner. If it's court ordered, normally 100% taken. If it's not, sometimes it's ignored, depends on the lender. all of that income can all go into the pot, and you'll have this figure which is joint. So for you and your partner, they'll assess it the same way. They'll get two incomes, put them together, and this is going to be the income that they're going to assess your loan by. Now, each lender has something called an affordability calculator, and 9 times out of 10 it is based on this affordability calculator. However, most of the time, and there are lenders that lend less, there are lenders that lend more, but as an absolute sort of go-to figure, and if you don't have up 10 dependents and lots of debt and any adverse, which I'm going to cover in other videos, then if you 4 3/4 times your income, you won't be far wrong with the loan size that you can get. So that gives you a really good way of working out what income the lender's going to use for you and what type of lending level that income is going to achieve for you. So about 4 3/4, 4.5 to 4 3/4 times your income, and you won't go far wrong with that. As I said, there are caveats to that. If you've got a lot of dependents, if you've got high debts, if you have other properties in the background that you have to pay for, if you have a maintenance payment you have to pay for, any adverse credits, any missed payments, default CCJs in the background, your age, so obviously the longer the term, so the younger you are, the longer the term, the cheaper the monthly payments, the more the loan. So obviously the older you are, the term reduces, and therefore that margin gets quite tight. So I'd be sort of erring on 4 to 4.5 times when you get to a smaller term for an older aged client. But that's a lot of information I've thrown at you there, but hopefully you can go back over this video and just sort of pause and rewind on the bits that suit you. If you've got any additional questions, please put them down. I want to help you. I want to tell you the answers. So I would love your questions. As long as it's not advice, which it won't be, because you'd have to go through the whole process to get accurate advice for you, but I'm more than happy to give you tips and information. And obviously if you want to take things further from this video, if you think, actually, I didn't think I could get a mortgage, but now I really understand it, and this is what I think I can get, pick up the phone. It doesn't have to be to me. Any broker will help you. We can pretty much all see the same products. So yeah, hopefully that might have inspired you to think, let me have a look at what I earn. Let me have a look at what my partner earns. Let's get things in check, let's really understand what we've got here and work out, what can we actually borrow? Could we buy that bigger house that we really wanted to? Is there a pay rise on the horizon? Could there be? Could I be now inspired to go for that extra qualification to get me that pay rise? Or hopefully it will just set you on a bit of a vision and a bit of a plan for what you want to achieve. So yeah, I really hope that helps you. I'm going to have another video because this has been way too long, I know, and I'm really concerned that I've thrown a lot of information your way. But I'm going to have another video next, which is going to show you the paperwork and everything the lender's going to want to see, so that you can get all of that ready. And you will just be the best client ever to a broker if you can prepare that well. So, and not only to the broker, to the lender, because they love it if you just send everything in one go. It makes their life so much easier. And yeah, it makes your journey to that property much smoother and less frustrating. So I really hope that this has helped you in some way. I do apologise if this is completely confusing. I'm going to obviously watch it back before I launch it on my channel. As I said, if there's anything you really want to know, please write it down. But I'm hoping that I'm going to do this sort of mini series to help all the newbies and people that want to understand more and prepare more with all the different elements to getting your mortgage for your residential or your buy-to-let. But anyway, I'm rambling again, so I'm going to leave you with that. And I'll see you in my next video. Thanks for watching. Bye.